Hi, I'm Sunil. I am doing a short slideshow on option trading. I started in November of 2021, my first trades, and since then it has been a learning journey. I have made substantial gains over the last few days because I mastered the Bank Nifty option trading on the Indian stock market. So I'll give you a brief introduction of what I have learned. Now, call options are one type of option which basically is a right to buy from a seller at a predetermined price called the strike price on expiry date. So, call options are purchased when we expect the market to go up because call option prices go up with rise in asset value. Now, the put option is exactly the opposite. It is basically a right to sell an option at a predetermined price called the strike price on expiry date. So when the market is going down, the value of the put option goes up. Now the price of the asset is the strike price. It could be above or below the current asset price. For example, IBM, if the price of IBM is 138, I can buy a call at 135, 134, 133, and I can buy a put at 137, 138, 139. So why do we have this difference? Is when the call is below the asset value, asset price, any increase in the stock market, in the stock price of IBM, the option price will go up and we can sell at that time to make a profit. And for the put is exactly the opposite. If the price of IBM goes down, the value of the put will go higher and higher. So we choose a strike price above the IBM current stock price. Now the time to buy a call option or a put option depends on the pre-market conditions prevailing on that day. Usually before the stock market opens, there is an indication that it will be an up day or a down day. And nothing is guaranteed. During the day, the stock market can go negative or it can go up. So generally, to start the day, I normally see the pre-market and I place small order for call if it's a bullish day and a small option for put if it is going to be a down day. Because as soon as the asset prices starts dropping, my put option increases in value, and if the stock goes up, my call options increase in value. Now, Bank Nifty options is my favorite because there's a lot of volatility in this option. It has given me spectacular results. A lot of people are involved in Bank Nifty trading, so there is a lot of movement of the value of Bank Nifty. Now, options are bought in lots. So, for Bank Nifty, one lot is 25. So, the price of the option, if it is 200, one lot means we are investing 5,000 rupees. Now, when you buy an option, let's say one lot at 5,000 and the market is going up, the price of the option, which is 200, will go up to 210, to 20, to 30, to 50. And when you decide that you want a profit, you can sell at any price you want, and the difference will be your profit. Now, what I have been doing is instead of buying one lot, I buy 10, 20, sometimes even 40 lots. That means 1,000 options. So I invest more in the beginning, but if the stock goes up, my returns are also much more. And there is also potential for loss if the market reverses. So for that we can put a stop order, that means sell at a price below the price you bought so that you can reduce your losses. Now January 28th, the market was in negative territory. As you can see, 37,689 was the closing value of the Bank Nifty. In the morning it was much higher and it dropped gradually over the duration of the trading time, which is 9:15 to 4 o'clock. So in my case, I started with put options because it was a negative territory, and during the day I also bought call options because there were times when the price was going up. So I buy both the options and take advantage of the up and down. Short sell means instead of buying, you sell option at a higher price, knowing that it will fall, and then when it comes down, you buy the option back. So the sell and buy has to squared off. When you sell, you receive money. When you buy, you give out money. So when you sold it at a higher value and bought it at a lower value, the difference is your profit. Now HDFC securities allow me to do the trading, and it comes under the derivative window. There are 4 windows called the order book window, which basically gives you the time of your purchase, the type of option, call or put, gives you the buy or sell, then whether it is executed or pending or cancelled. Pending means you have put a price but the order has not been executed, so it will show pending. And executed means your order has been executed. The trade window is basically giving you the summary, the breakdown of, suppose you have purchased 1000 stock, 1000 options. So each transaction is given starting from 25, 50, 25, like in multiples of 25, and at what prices they were purchased or sold. So you get an idea of how much money has been spent and how much money has been recovered, which is shown in the line here, which is the total buy and total sell. So the difference will show you whether you are in profit or in loss. Now the third window is called the open position window. What is the use of this window? Number one is it is used to square off your position. If the order is executed, immediately it comes in the open window. You can see whether you are making a loss or profit by comparing your purchase price with the current price and the quantity. So when you press square off, it will open another window for you to square off that particular transaction. So if you have bought, you will sell it. If you have sold, you will buy it. So square off is very essential, otherwise losses can happen. Now how to buy an option? So firstly, we select the expiry date, we select the strike price and the type of option. Now in this case it is a put option. The strike price I have selected higher than the asset value, and on this particular expiry date the option is being traded at 211. Now this can change very rapidly depending on the movement of the stock. So I can press buy and open another window where I enter the quantity. This 25 is default. I can put 50, 75, 100, all the way to 1200. I can set the limit. If I don't want 211, I can put here 200 and I press place the order. So the order will go in pending which will be shown in the first window I showed you. And as soon as it's executed, the status will change to executed from pending, and in the open window it will show as a transaction has been done. So now, depending on when you want to square it off, you click the square off button, and again this window opens and you can place the sell or the buy order at the price you choose. Now I have learned tremendously from Option Playbook and Option Trading Quick Start Guide. So if you are keen to learn, you can pick up these books on Amazon. Some of the sites I've used is Tastyworks for US, HDFC for India. Zerodha is open for people, and I believe they have no charges for transactions. Robinhood is for US. Moneycontrol.com is a very valuable site to see the index movement, for Bank Nifty or Nifty or any share. It keeps showing you live. I hope I have cleared some of the mystery of option trading by this exercise. If you want, you can email me your questions. I'll be more than happy to answer them, and I wish you all the best for your trading. Thank you so much.